You are watching Trading Day on BNN Bloomberg. We have been breaking the latest Fed rate decision. Their decision to keep rates on hold widely expected. They made a lot of changes, though, to their statement that we'll get more color on during their press conference, which should kick off in about 20 minutes time. It was a fairly balanced statement, though, all told. On one hand, they removed explicit language about the next move being affirming of policy, so that's gone. On the other hand, not quite feeding the doves, basically saying they need to assess under what conditions they would cut rates and that they would need greater clarity on inflation getting back on a sustained basis 2% target. But they are at least talking about those rate cuts. Let's bring in Gennady Goldberg, who is the head of U.S. rate strategy at TD Securities. And still with us is Claudia Sahm and James Demmert. Gennady, I'll give you the first word here because depending on your view, right, you could say this is a hawkish statement or a dovish statement. How are you thinking about what they came out with today?
I like your statement, actually, that it's a little bit of something for everyone. And I think depending on your view, you're right. I mean, you could point to the hawkish stuff, the dovish stuff. At the end of the day, what I see this as is their broader ability to just pivot towards a move at some point in time, whether, that's a downside move at some point, but also, kind of feeding the other side and suggesting that they're not quite ready yet. I mean, you're correct. They basically put the statement in a better place to, if they wanted to cut rates, they can certainly cut rates, but they also suggested that they're not necessarily going maybe as fast as some of the folks expect, that they still have to see the proof in the pudding on inflation and some of the other data to actually convince them that it's time to go.
And where's your best estimate on when that first rate cut occurs?
So we're still expecting them to go in May. At the May meeting. I don't think March is quite it, but I do think the statement is set up in such a way that it gives them maximum flexibility. If by the March meeting, and we'll get a couple of additional data prints by then, especially inflation prints, if by then they decide that they've seen enough on the inflationary side, that they've made up their minds, I think they can make the case that it's time to go. But we still think they'll want to hold off for a couple more months and wait until May, wait until they have kind of an abundance of information and can really determine that, they can go very gradually, very carefully, and start that rate cutting cycle at the May meeting.
Claudia, we were just talking about how you think they have the leeway to go right now, but they aren't because of various fears. And you mentioned 1970s, and that seems to be the boogeyman, always the blueprint that people go back to, double dip, inflation. Is that not the right blueprint for the situation that we're in right now?
It hasn't been the right blueprint from day one, and yet that has come back again and again as inflation spiked in 2021, and it's all about demand. We need a recession. I mean, the Federal Reserve never said that, but they were really clear in their forecast. They thought we would need a slow growth period to get inflation down. That was the 1970s. This is not the 1970s, and that we're still kind of in that mindset is really mind-blowing, but that's where we are. I absolutely agree, May at the earliest for a cut. I think there's justification now, but I don't see the path. And frankly, this statement should be a confirmation that the path to March is a really tough one. I just don't see that as where they're going to go.
And James, you've been saying that assets, if the growth is there, they don't necessarily need to see it any sooner than what the market is willing to price in here.
No. And I think investors should be really careful waiting for the Fed to cut before they get more invested or invested at all. I mean, you've got great earnings, a very resilient economy, and you have a Fed that, like I said earlier, they've got this thing right where they want it. They've got inflation close to their PCE target, their favorite one. One could argue it's even less than that. They have a resilient economy. So I think that investors should be really careful from that standpoint anyway. To not be an invested person. I mean, I would even use any weakness that this might cause by confusion for investors to buy more equities, particularly, since the price earnings ratio for most stocks is on the low end. So yeah, I think they've got it where they want to. I love that statement. They took out firmness as a possibility. They're in neutral territory, which is a really smart way to play it. And I think that like your guest said, there's a little bit of something for everyone in this statement so far, and that is a good place to be for investors with a strong economy and rates and inflation more manageable.
Gennady, globally, this is expected to be the year of rate cuts in Europe, in Canada as well. But given that the U.S. Kind of stands out with the most robust economic growth, do you think it's more likely that they're going to be a laggard when it comes to the rate cuts versus a leader here?
So it's interesting. It's a two-pointed question. It's a laggard in terms of the start of cuts, or is it a laggard in terms of the total number of cuts? Right now the market's pricing in, call it about 150 or so basis points of rate cuts in 2024, which I think is relatively aggressive. Given where the economy is at the moment, I think there's room for the economy to slow down. I think we're seeing that in some of the sub-indicators, like the payroll report, for example, and some of the more nuanced labor market indicators like JOLTS. But it's a question of, do we start first and go more, or do we, start later and go a little bit less? I think that's really what the Fed is trying to dial in, which, I would say for markets is going to be very difficult to actually price in, and it's going to lead to a lot of volatility. Markets don't really love turning points. They have trouble pricing the real kind of turning points in the economy, real turning points in the markets themselves. And I think it's going to create a lot of investor caution, because some investors are going to expect the Fed to cut sooner and faster. Some of them are going to expect the Fed to go later and really not cut all that much. And it's going to create a lot of volatility, I think, in the next few months as we try to dial in exactly what the Fed's reaction function is.
Are we being too dismissive of the chance that maybe there isn't a rate cut? As I say it, I know it sounds kind of explosive, but it's all predicated. The undertone of all of our conversations are when there's a slowdown, when there's a slowdown. What if there is no slowdown? What if the numbers just continue as they are? What is the impetus for the Fed to cut it all? Claudia, maybe you want to kick off that conversation?
We have inflation moving rapidly to the 2% target that the Fed has set. When they get there, and especially if it hangs there, they should be out of the way. Like, not just cutting, they should be back to a neutral interest rate, because their job is done, right? So they got to get going if they're going to get to 2%. And honestly, and again, Chair Powell said last time, we don't think anymore that we need low growth, that we have to have it to get inflation down. They've got a mandate, that's it. Right. So I think, and we've made a lot of progress on inflation. And you asked about other countries. There's another piece of Europe, and our peer countries have much slower growth, haven't come out of this. And some of them are starting to see some signs of stickier inflation. And many of them just have an inflation mandate.
James, because you referenced corporate earnings growth, I mean, that is the economy, right? These are the companies that are telling you how things are going, and by and large, it's pretty well. I mean, what do you think of that thought experiment, that what if growth doesn't force them to cut?
I think it's a very likely scenario. We've been saying, for the last quarter, people are just over anxious about the Fed cutting, and it may not be necessary. I mean, I think we're at the beginning of a new business cycle, one that's, led by AI and greater productivity. It's possible that the economy continues to grow really at a great pace. We already know inflationary data is accelerating, right? So it's possible that it just keeps going on like this, where we continue to pause because everything is resilient. Corporate profits are strong. And I have to go back to the point of, they have an option here. They have the economy and inflation where they want it. They can either start cutting rates by, slowly like a golf cart start, or quickly like a Formula One car. I mean, they can go quick and big, or they can go slow and steady, but they're going to need better data to make that move. And I think that's why investors should, again, less Fed information, more earnings. That's what drives markets.
Gennady, I'll give you the last word on that point.
So I actually disagree a little bit. I think they can actually start to cut rates without data actually turning progressively lower. And I agree with the earlier guest who was talking about inflation. I think inflation is coming down. So I don't think we're saying fundamentally anything that different, just a very different way of putting it. We've got inflation coming down towards their target. If it continues to stay where it is, they are very much in the clear to start decreasing rates towards a more neutral level. The last thing they want to do to avoid that race car style type of cut, which is, by the way, how they do 99% of historical rate cutting cycles, is, they have to start early and they have to start cautiously. I think they want that. They want to make sure that the economy doesn't keel over, that they don't over tighten. And you have to remember, as inflation comes down, they have to actually start to lower rates a little bit. Otherwise, they can be, I would say, at risk of over tightening. And I think that's their primary concern at the moment, which is why they're balancing that statement a little bit more towards neutral. And we'll certainly see how Chair Powell describes that in the press conference coming up.
The Federal Reserve made a trend-setting interest rate decision, keeping rates on hold for a fourth meeting, but making a lot of changes to its statement. On one hand, dropping its explicit tightening bias. On the other hand, saying it needs to see more progress towards its inflation target before it considers cutting rates. We've been joined by Claudia Sahm as well as James Demmert. Claudia, as we are just a couple minutes away from the press conference, what do you want to hear from Chair Powell?
Well, I'm not going to hear what I want to hear in terms of them, getting ready to cut. He's going to just flesh out the statement. And frankly, I expect to hear a masterful performance in saying nothing more than the statement. His press conference in December created a lot of excitement in markets, like the Fed's getting ready to go. And frankly, I think that was probably dialed up more than what the FOMC had wanted to do. So I think he's going to try to be really neutral today.
And we'll see the effect that has on equity markets, James, which are already kind of in a bad mood because of what we've seen out of tech companies.
Yeah, that is true. Although earnings days are not usually reflective of what stocks end up doing, 3 months out. But I think he's going to be really careful. He has learned from recent meetings about juicing the stock market too much or too little. They are aware that the stock market has something to do with the overall economy.
In the statement, they are saying a couple of things. One, they don't see cuts until they're more confident that inflation is nearing 2%. So this is something that, despite the economic data being strong and inflation coming down, a lot of Fed speak has said, maybe we can afford to wait and see, because what they'd hate to do is cut and then have to raise again because inflation re-accelerates. So the key point here, they don't see cuts until they're more confident that inflation is nearing 2%. They say risks to their goals are moving into better balance. So that's another thing that we've been tracking. How do they think about the risk to inflation? Are they tilted towards the upside or the downside? Here they're saying they are moving into better balance. So that initial line, and if we can take a look minute by minute at the markets, is being viewed as hawkish. The S&P, which is already under pressure going into this because of pain in the tech sector, is now trading at the lows of the day, has slumped down to 1% as the key line. And again, as our former colleague Francis Hordelski used to say, the first reaction can often be the wrong reaction, but the key takeaway from the initial read of the statement is that they are a little bit more hawkish, that they would like to see a little bit more progress towards that 2% target. And we are seeing further pressure. That's kind of the knee-jerk reaction right now to this statement. In about half an hour time, Jay Powell will begin a press conference. Well, he'll be peppered on all kinds of questions around the outlook, that first rate cut. I'd like to bring in Claudia Sahm, who is a former Federal Reserve economist and head of Sahm Consulting. And on the equity side of things, we've got James Demmert, the the CIO of Main Street Research. James, as I mentioned, the knee-jerk reaction is to kind of see markets move lower. And that is just kind of the one line that I've keyed in on as the cause of that. Should we really be surprised, though, that the Fed is erring on the side of caution?
I don't think we should be, Amber. I mean, they've got this economy right where they want it, and I mean, good for them. They messed it up, going into the high inflation we had by waiting too long. But this time, I mean, they've pulled off what I would consider a miracle. You've got a resilient economy. You've got inflation, their favorite indicator, PCE, less than their actual target. It's no wonder that they're pausing. And this market selling off, I mean, let's wait for the presser, right? We have to see what the commentary is. But this is the beginning of a new business cycle bull market. And, these are driven by earnings. And those Microsoft, Google numbers are just a good example yesterday, even though we can talk about that further. But earnings are going to drive stocks here. I don't think investors should be expecting the Fed to immediately cut rates. They're going to be really careful. They've got it right where they want.
So the line, just to reiterate, that seems to be stoking some of the fears is that the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving substantially toward 2%. Don't we already have that?
As far as I'm concerned, we do. And I frankly think, they are very acutely aware that pushing rates too long, too far is going to bring on another risk, which is obviously a much weaker economy. The community bank in New York today, down 35% the stock, because the earnings miss was huge and they slashed the dividend. That could be one of those beacons for the Fed to say, okay, wait, we should be careful here about how long we want to stay, higher for longer. I do think they'll cut. But again, I think investors are being way too overzealous about how much and how soon. The Fed's got it where it wants. They're going to take their time and look for signs of when they really need to. And let's remember, when they start cutting, I mean, if they have to go in a hurry, they can just go big. They go 50 basis points if the signs are showing them that they need to. So I think they're doing the right thing here, Powell, by just being patient and let the data come to them.
I want to now bring in Claudia Sahm. Claudia, as I mentioned, the key statement that the market seems to be keying in on is that the Fed is looking to have greater confidence that inflation is moving substantially towards 2%. And James was hinting at the fact that, the Fed has maybe the luxury of time. They can wait to see how things progress. Because even with where rates are right now, growth is remaining pretty robust. How are you thinking about that interplay?
The Fed, everything the Fed is doing right now makes perfect Fed sense. And yet it is absolutely not what they should be doing. They should be starting to cut interest rates gradually, but they should get it going. The idea that they have the luxury of time is misguided, frankly, because it's not just about the economy, the weakness. We've seen some signs in the labor market that things might be not quite as strong as they've been. And also the Federal Reserve works through financial markets. There are many interest rate sensitive sectors. We talked about the bank today, and they had some commercial real estate loans where you're really pushing it. A lot of the financial markets, some of these credit, they've kind of held it together and largely well because those interest rates will come down. The longer we push that out, the greater the chances the Fed, as it usually does, breaks something. And we don't want that.
You said the Fed should be cutting rates now. If you're looking at the commentary that many Fed members are saying, they're afraid of doing just that because they don't want to have to, and other strategists talk about this, they don't want to cut and then have to hike again because inflation went the other way on them.
Right, but it doesn't make any sense, right? The Fed makes adjustments. The world changes, right? Things could happen that could push inflation back up. Frankly, it is clearly going down to 2% right now. So what's the big problem of cutting 25 basis points? Something in the world happens. Oh, we have to raise it 25 basis points. Like, this is not that unusual, except no one at the Federal Reserve wants to be Arthur Burns. Right? We're back in the 1970s in their mind, and he did make mistakes in terms, and particularly listening to Nixon in an election year and cutting. So I think there's all kinds of things going on, but it's more like psychological baggage at the Fed than it is like looking at their tools, looking at the world.
James, I'd love for you to pick up on this point that cuts should happen now and the Fed shouldn't be afraid to, have to raise again. Wouldn't that introduce a lot of volatility for assets?
Well, let's try to hope that the Fed's not thinking about the stock market, although I think they do. I mean, the concern that I would have for them to be, so generous about cutting rates today or a lot in the next meeting. I mean, I definitely think they're going to cut in the next quarter or two. But my concern is you've got a very robust economy. You've got a tight labor market. And, in a world where we didn't even have any inflation, one would wonder why they'd be cutting. I mean, there's not a lot of reason here. Earnings are healthy. The economy is super resilient. I think the risk that they think, that they're probably concerned about is if we cut here, the market expectation might be, or even, a lot in the next meeting, market expectations may get way overzealous, if one could argue they haven't already. But also the economy could certainly, from these levels of pretty resilient growth, certainly bring the inflation rate back up. And you're right, they don't want to be Burns. I agree. I just think that here I think they're better off just waiting, and again, not a long time, but waiting for better data over the next few months.
Claudia, how do you respond to that, particularly on the labor market? Because this is where you spend a lot of your time.
Right. So first, I just underscore the Fed's job is the dual mandate. If inflation is going to 2%, and we saw last year a massive amount of disinflation with growth that was really good, we have productivity growth that looks really pretty good. So there's no reason inflation cannot come down with growth staying high. And they do have to pay attention on the other side of the mandate and the labor market. I think we've gotten a lot of information, like out of the job openings labor turnover survey, that things really are not as quote unquote tight, right? We don't see the hiring rate much above where it was pre-pandemic. That was a good labor market, but that wasn't what we've seen in the last few years. So I really think the Fed needs to keep the eye on the prize here and follow their job, as opposed to getting into thinking about the markets is really, I think, goes down a path they don't need to, particularly because the wealth effect, so what we typically see people spending out of the stock market going into the real economy, is really pretty small.
I just want to inject some more color coming out of the statement, because I know I've been mentioning that statement that seemed to have caught market participants a little bit by surprise, where they said they don't expect it will be appropriate to reduce the rate until they're more confident that inflation is moving sustainably towards 2%. So that was viewed as hawkish. I should also mention that they did kind of drop their explicit tightening bias, replacing the sentence of requiring any additional policy firming with something else, saying instead of policy firming, now they're saying any adjustments. So those adjustments could be up or those could be down, but kind of introducing that flexibility. So I don't think it's as hawkish as perhaps the market initially read this. But James, does this matter if you're an investor? If you think about the rally to all-time highs, and yes, it was concentrated in tech, but this happened on the backdrop of rate expectations being pushed out, right? A March rate expectations, for example, declined as the market rallied.
Yeah, I mean, in some ways that makes sense. I mean, but to be honest with you, I think that the reason that equities have done so well from the low in October, let's say, of last year, is really earnings driven. I mean, there has been some incredible earnings that have been reported, even if one wants to pick the reins out of the cake about, maybe Google's ad revenue wasn't as expected. These numbers are fantastic, and not just in tech, but across a lot of different parts of the market. So I frankly think that the Fed conversation is just overdone. I mean, they're finished. We know that on the hiking. And now it's just a matter of when they start reducing rates. And one could argue they should have done it today or next meeting. I don't think that matters. I think investors should be better off focusing on companies who have great margins. And I like the comment about productivity growth. One cannot ignore that the AI is real, and you're seeing it already show up in some of these technology companies. Productivity growth is going to be a key issue. It's going to be stronger than the last cycle, and that's going to make profit margins even stronger. So the Fed should be careful here, and the market can go up without the Fed needing to assist it every meeting and by cutting.